Hey everybody, Smart Silver Stacker here. Hope you're doing well. Welcome to today's live stream. Now let's just get right into it today and let's break down why a bet on the US dollar here is a bet on the fundamental strength of the US economy, and why a bet on silver is a bet that the US economy is actually, in reality, a dumpster fire of exploding debts and deficits, and that the economic data which portrays a picture of strength is in fact manipulated, cooked, otherwise unreliable. Let's break that down today, and let's discuss how we just entered, or perhaps are on the cusp of entering, an era of unlimited borrowing and expansion of the debt. By the way, if you want to bet on silver, make sure you check out today's video sponsor, SD Bullion. You can buy your gold and silver at SD Bullion. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/news. So check them out. So let's take a look at what's going on with the dollar today and silver. Silver down a little over 1%. Down right around $29. Looks like we are in the midst of this C wave correction. Now, I talked about this in the live stream yesterday, how silver's rally, which kicked off in February, followed the pattern of a Elliott wave move higher. 1, 2, 3, 4, 5 here on the chart. You get an ABC correction following that, and then we just had another 1, 2, 3, 4, 5, which topped out around $35 in October. Now we seem to be on the downward end of a correction. How low will silver go? It's a good question. Kind of all depends on what the Fed does at this point. Of course, in this economy, which is predicated on artificially low interest rates, all that matters is what the Fed does next. And I see some familiar faces in the chat. Hello, welcome. Thanks for joining the live stream. Don't forget to smash that like button. If you're new, subscribe to the channel. It's not always just live streams like this. I do some more polished videos as well, but we always cover geopolitics, technical analysis, gold, silver, the dollar, the looming debt crisis, all that good stuff. So if you like that sort of thing, make sure you subscribe. But silver's down today. The dollar index is at the highest level in over a year, over 108. It surged yesterday following the announcement of another 25 basis point rate cut by the Federal Reserve. But what the Fed also did is they adjusted market expectations for further rate cuts in 2025. Take a look at the CME FedWatch tool now. At the next FOMC meeting in January, market's only pricing in an 8.6% chance that we'll get another cut. Vast majority of investors believe that the Fed is done cutting for now and that we're only going to get 2 cuts in 2025. In fact, if you look at the FedWatch tool, 37% of investors are factoring in just 1 cut, 18% no cuts next year, 29% 2 cuts. So, I mean, really what's going on here is that the anticipation of further cuts by the Fed has diminished significantly. And this is all based on the idea that the US dollar is stronger, rather the US economy is doing great. We've had this soft landing, everything strong. Today's action with further increases in the US dollar index and a further decline in silver is outlined here in this article from barchart.com. Dollar supported by US economic strength. What did we get? Well, we had a unemployment claim that fell to 220,000. That was against expectations of 230,000. And US Q3 GDP was unexpectedly revised upward to 3.1%. That's stronger than expectations of no change at 2.8%. So the idea is that if the US economy is so strong, you got GDP up, unemployment down, then the Fed doesn't need to cut. Right? Inflation's on the rise once again, so maybe the Fed is going to err on less easy money. Now, the problem with that is that the debt, the level of debt, is absolutely exploding. Over the past 2 months, the first 2 months of fiscal year 2025, that's October and November, the U.S. Treasury went into debt, more debt, by more than $600 billion. Now, if you annualize that, it's a huge annual deficit, something like $3.7 trillion that we would be borrowing if we keep going at that rate. And very likely, that rate is going to increase. And, markets in some ways are not real happy about that. Look at the 10-year yield. This is the yield on a 10-year U.S. Treasury note. Over the past 5 sessions, this has risen by 5.69%. That's a big move in what is supposed to be the most liquid debt market, the deepest debt market in the world. You have got the pace of borrowing and a more hawkish Federal Reserve causing the yield on U.S. Treasury notes to skyrocket. And along with that, the cost of servicing the U.S. debt, which is now over $1.2 trillion, is on track to become the largest item on the federal budget. Clearly an unsustainable situation. So what's the solution? Well, talk about the era of unlimited debt. Today, Donald Trump has called for the abolishing of the debt ceiling. So he smacked down the omnibus spending bill, more than 1,500 pages in Congress. There's a looming government shutdown as a result. I mean, this is all a lot of theater as usual. And now look, Trump says that the debt ceiling is meaningless. And I mean, he's correct. That's not wrong, because Congress always just raises the debt ceiling anyway. Politicians love to spend taxpayer money, especially when they don't actually have to tax them directly, when they can simply tack the money onto the already enormous levels of debt, which nobody really seems to care about, and tax everybody via the hidden tax of inflation. But Trump is saying here that he wants to eliminate the debt ceiling entirely, which is interesting because this is something that for a long time Democrats have called for. And you have the, supposedly conservative Republican Party has tried to use this to get concessions and to maybe perhaps pay some lip service to fiscal conservatism. But now you've got a Republican president saying he wants to simply eliminate the debt ceiling entirely. He says it's the smartest thing Congress could do and that he would support it entirely. Now, that should give you a clue as to what's about to happen to the U.S. national debt. If you've got an incumbent president calling for the elimination of the debt ceiling, do you think this number is going to go higher or lower? Kind of might give you a little idea of how effective the Department of Government Efficiency is really going to be. There are no plans to massively cut spending. It's not even possible. Items such as Medicare and Social Security are completely politically unviable to cut. And if we do head into an economic downturn, which is likely as the Federal Reserve is now pulling the rug out from under the market as Trump is heading into office, and look, I mean, that's no surprise, that's not a coincidence, then the market crash that results will lead to untold stimulus and printing by the Federal Reserve. And, maybe now and during election season, there was a lot of lip service paid to government efficiency and cutting bureaucracy. But when an economic crisis looms, when a stock market crash looms, when a debt market sell-off looms, which we're already beginning to see with spiking U.S. interest rates on U.S. Treasuries, there will be no talk of cutting spending. There will only be stimulus, and it will be because there's a crisis, right? He had to do it. He had to conjure up trillions of dollars and spend it into the economy and use the Federal Reserve to monetize that debt. And that is likely what is in our future. That is why the debt ceiling is now going to be revoked. And if you think that everything is in good shape, like the economic data, quote unquote data, revealed today that the U.S. economy is in great shape, then bidding up the DXY makes a lot of sense. But if, like me, you have a conviction that the rosy view of the U.S. economy is based on fake data and based on data that is designed to portray the U.S. economy in a stronger light than it actually is, then it might be a good time to take advantage of the dip in the precious metals, both gold and silver. I mean, gold has gotten pretty beat up over the past several sessions as well, but silver even more so, as is usual. Silver is certainly a more volatile market than gold, to the upside as well as to the downside, but you can scoop up some hard assets today at a discount, and silver could certainly fall further from here, although I don't think that the bottom is too far away from where we're at. But when the Fed begins to print and when they're forced to intervene in the economic crisis, which they are issuing in right now, well, I suspect that the gold and the silver price are going to be heading a lot higher. And just like when silver was at $35 or very close to that price in October, and a lot of people were kicking themselves for not buying when it was cheaper, I think that right now is one of those times when we have an opportunity to acquire some hard assets at a lower price, and that those who don't take advantage of it will regret it later. Again, this isn't financial advice. This is just my thoughts on the matter. I will be looking to add 2 positions around these prices. If it drops further, I'll buy more. I'm not going all in. As usual, I'm dollar cost averaging, but I think all signs point towards a lot more money printing in the future, not the least of which is the call from the new president to completely remove the debt ceiling. That shows you that the plan is to continue with massive deficit spending, and currency debasement, and the Fed is going to have to get a lot more active to monetize all of that debt. So let me know what you think in the comments down below. If you'd like to see more videos like this one, make sure you check the one out that is popping up on your screen right now. If you haven't liked or subscribed to the video, please do that. You can follow me over on X at x.com/stacksmarter. Also, you can sign up for my free newsletter with the link down in the description. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time.